So firstly, welcome everyone to our Thursday podcast. It's a pleasure to have everyone on. And we're honored today to have Randy Cohen, who's a business school professor, ironically teaching a class at Harvard Business School that was my 100% favorite class when I went there many, many years ago. But that's a story for another day. But I feel it's almost like fate for me that Randy is now someone that I have a relationship with, especially after having such a tremendous experience with his class and his previous professor who taught that class. But we're delighted to have Randy on. Randy, you're someone who studied the financial markets for decades. So seeing the disruption in the market now is not something that's new to you. You've seen bear markets, you've seen Fed tightening cycles, you've seen inflation. So I'll just say you have tomorrow's Wall Street Journal today. You have opinions about where markets are headed, how to respond to this disruption and turmoil, and how to survive this. Do you think those are fair comments?
I don't think it's fair to say I have tomorrow's Wall Street Journal today. But what I'd say is there are some fundamental principles that we've learned over the years that we can employ. And obviously some of those principles are now well known to everyone. And so I'll try not to waste too much of people's time with things that they all know. But I think some of those other principles are pretty well established in, the research in terms of either being so deeply logical that they have to be true or in being supported by empirical regularities historically. And that some of those are not that widely known and are worth sharing.
Okay, terrific. So we're going to go through a few standard slides. So I'm going to ask James to advance the slides. I'm going to go forward. Go to the next slide, please. Okay, you can't have a talk without having a disclaimer. So this is our standard disclaimer. It's no different than what we had in the past, but essentially we're allowed to educate. We're regulated in terms of giving advice, financial advice. So everything we're sharing today is in the spirit of educating you to be a more effective investor. So if and when you want to read this line by line, feel free. But I'm going to ask James to go to the next slide, please. So here's a little bit of background on us. I'm going to let Randy tell us the Randy Cohen story in a couple minutes. So you know my story from being a partner at Catterton, running the private wealth practice at McKinsey, my time on Wall Street with Morgan Stanley, both New York and London. And obviously, Randy and I both have Harvard Business School in our background. Both of us went there, and Randy still teaches there. So Randy, tell us the Randy Cohen story.
Yeah, so I've been teaching at Harvard Business School basically for the last 25 years. I say basically because in the middle, I went and spent a few years at MIT Sloan, and in fact, actually for a brief time, taught at both schools simultaneously. So that's been my main career. Prior to that, I got my PhD at University of Chicago, studied under the great Eugene Fama, Nobel laureate, and then prior to that, I worked as a actuary management consultant and so sort of studied asset liability matching and investing and related areas. Since I became a professor, my focus has been on capital markets to a great extent. So I've basically been studying how to build a great portfolio of investment managers. So how do you find which strategies are going to work the best? How do you find which investment managers are going to have the most success in the future, not just the past? As we always joke, it always says on the information from asset managers something along the lines of past performance is no guarantee of future results. That's the legal boilerplate. And I always joke this is sort of the truest statement in the history of legal boilerplate. Like, not only is past performance not a guarantee of future results, it doesn't even really seem taken at face value to predict future results. But what it turns out is if you are able to do careful analysis of past performance and understand it in the context of the markets in which it was developed, past performance can help predict. But if you just pick the people with the high past returns, you're going to make the same mistake over and over, which is, value is going to have a good run and you'll then invest in the value managers because they have good performance. And then it's time for growth to have a run. And so you'll underperform. And then when growth is having a good run, you'll say, oh, I got to switch back to growth. And then it'll be too late, and that'll be a common and consistent pattern for people who just try to look at past returns. So you have to be more sophisticated in your thinking. And we study all that stuff. I also, and so I teach an online course at Harvard Business School called Alternative Investments, and I highly recommend it for people who are interested in alternatives and want to really beef up their knowledge base. Anyone can sign up for the class. They'll charge you some money, but it costs a lot less than taking a class in person at Harvard. And then I also teach a class called Field X, which is an entrepreneurship class. It's really a course. It's like an incubator for startup businesses coming out of Harvard. And we have about 100 businesses a year, of which probably 30 or 40 end up launching as sort of full-time occupations for the students after graduation. And the rest of them are just high quality student projects. So a lot going on, keeps me busy. And then I help people start investment businesses. And of course, work closely with you, Mark, and our group, and with some other firms as well who may come up in the discussion at some point.
So what do you do when you're not sleeping?
Yeah, exactly. Well, here's the thing. I'm blind. I'm not 100% blind, but so I'm probably like, we don't really put numbers on it, but I'm probably like 97% blind. And so a lot of things that I did for fun when I was young and could see, like play basketball or water skiing or even watch television, I can't really do those things so much or so effectively anymore. And so the upshot is I'm very fortunate in that I found work that I love. And so while it sounds like I do more than other people, I think it would just be more accurate to say that that I spend my leisure time on activities that might look like work to another person, but they feel like leisure to me because they're so much fun. I mean, when I get on a call with you and the team, Mark, there's no part of me that's like, oh, I can't believe I got to slog through another hour of work, right? We're thinking about the hardest and most interesting questions in the world of finance and investing, and with some of the smartest people around, it just couldn't be more fun.
Well, that's a beautiful send off to the next slide. So James, if you'd be kind enough to go forward. So some of you have seen this before, but I like this as a repeating slide so that people have a framework from which they can take the education we're providing and slotting it into their own net worth and private wealth planning. So I consider private wealth a four-legged stool. One leg of the stool is your net worth, which is a combination of your investable assets and your non-investable assets. Those are things like your house, your jewelry, your collectibles, et cetera. But in combination, that's your net worth. And around that, you need things like trust and estate planning, tax planning, emphasis on planning, because honestly, anybody can fill out a tax form for you. That's not value creation, in my opinion. But planning future taxable events is a big deal. And that's something that we've touched on briefly. We will, on a go-forward basis, having more sessions on how to minimize your tax burden. As we get closer to year end, that'll become more and more urgent for people to address that. And we have some really powerful things to do work. And lastly, insurance. And again, to remind people, I am not an insurance broker. However, there are products in the insurance space used wisely and correctly give you additional tax deferred vehicles. And that's the name of the game, to earn income where you don't have to pay the tax. That's a beautiful thing. So that's the four-legged stool of private wealth that we're delivering to our client base. And we encourage those on this call that are not taking advantage of these resources to reach out to us, and we can share with you how we can be helpful. So James, go to the next slide. So just as a reminder, the name of the game that I was taught at my time at McKinsey, and I believe it strongly, is asset allocation is vital. It's over 90% of where your return attribution comes from. And the chart on the right just shows you three simple data points. If you have a portfolio that's 100% fixed income, 100% equities, but you want to be in that top left quadrant where you have the highest return with the least risk. And the portfolio allocation that we deployed previously achieved that outcome. So we're very proud of it. And there are elements of that that everybody can benefit from. By the way, the
wire transfer
is extremely tax efficient.
To initiate or approve it out, please hold.
All right, James, next slide, please. Okay, this is the one slide on education, but it's important that we put this out there so we can talk about fixed income, current yielding investment opportunities, and how to assess the risk of this stuff. And I'm talking to a PhD from Chicago, so it's not a fair fight. But Randy, the slide that's on the screen now is talking about duration. And it doesn't go into the formula for duration, but in essence, it shows on this chart, if you have a fixed income product that has a 2-year duration on it and the market moves against you 1%, then that essentially reduced the value of your investment by 2%, because that's how duration works. And if you have a 6-year duration asset with a 1% rise in rates, you lose 6%. So duration moves in the opposite. It has the multiplier effect of harming your fixed income portfolio as rates rise. So when you're going to share with us some of your product ideas, obviously you're going to talk about duration. So I just wanted to put this out there for the audience so they have some understanding what this means.
And as a reminder to everybody, the reason they call, if you think about it, what Mark just defined is the sensitivity of an asset's price to interest rate movements. And as Mark says, it tends to be negative, right? If rates go up, the value goes down. So it's an opposite kind of thing. But what he's saying is, okay, duration is a word that means how much does the asset's price move for a given size move in interest rates, right? But duration's a funny name for that, right? You'd think they'd call it, sensitivity or elasticity or something like that. The reason they call it duration is because in one of, I think, the most astonishing results in elementary finance, the length of time, the average time it takes you to get your money back on an investment is the same number as the sensitivity to interest rate movements, right? It's not at all obvious to me that this is true, but I can prove it mathematically, so I know it's right. And so the idea is that, yeah, if you have a 30-year zero coupon bond, then if interest rates move 1%, you lose 30%. If you have a 30-year bond that pays interest every year, well, then some of your money comes in that big bullet payment at the end, but some of it comes all along. It might have a duration of, 16 years, and then you get a 16% loss. So that's very useful because later we're going to talk about duration of assets where it's less obvious what the duration is, like stocks. And that same interest rate sensitivity works. If a stock takes you a long time to get your money from it because it pays very low dividends today and it's going to be made up for by high cash flows in the future, that's going to be very sensitive to interest rate movements. And if you have a company where the payouts are all going to come in the next few years, that's going to not be sensitive to interest rate movements. So that's what duration is all about.
And just to build on that comment, Randy, when people in the current market have been holding their tech stocks, which are arguably long duration assets because there's not a lot of current dividends, cash flows, would you think that they're more sensitive to changing interest rates or less sensitive?
So that's right. So growth stocks, tech stocks, anything where the current dividend yield, the current cash flows are low relative to price, but the value they have is because of a belief that in the future, those cash flows will be very, very high. Take Tesla as a canonical example. Those are long duration assets, right? And to give you an idea how long the duration is, if you think about it, there's sort of a simple rule of thumb that says that the duration of a stock is the inverse of the dividend yield. And we don't have time to derive that. But in other words, if a company has a 3% dividend yield, that says it's got a 33-year duration. If it has a 1% dividend yield, it says a 100-year duration. That's probably a little too simple, right? Obviously, there's companies that don't pay any dividend at all. But if you do more sophisticated versions of this, you're going to get results something like this. For growth stocks, tech stocks that aren't making a lot of money today, but that have huge, boundless long-term potential, duration is probably about 50 years. For a value stock where you're getting high payoffs today, maybe it's an oil field where the value is all today and it's going to be played out over the next 15, 20 years. Duration could easily be 10, 15, 20. Let's say for value stocks as a whole, 15 or 20. Okay. And so think what that means. With stocks, you want to be careful about duration. When we talk about multiplying by the interest rate, normally, of course, people use nominal rates, and that's totally appropriate for bonds because bonds have fixed nominal payments, right? You buy a government bond at 4%, and it's going to pay you 4% a year every year. If you buy a $1,000 bond, you're going to get $40 a year every year. But equities aren't like that. The more inflation there is, the more the earnings of equities grow over time, right? Now, of course, you're getting it in funny money, right? If you have tons of inflation, then you're going to have your earnings might double, but it might just be because the dollars are worth a lot less. Still, if you want to use duration calculations on stocks, I urge you to use real interest rates, not nominal interest rates for that purpose. Well, so what's the real interest rate? Well, the government sells Treasury inflation protected securities, 30-year bonds. Well, they sell various ones, but a 30-year TIPS is a 30-year bond where the payment to you is bigger if inflation's higher. So it's inflation adjusted. And that gives you an inflation adjusted or real rate of interest, okay? And what is that rate? Well, it was minus 0.5% real. In other words, you got inflation minus 0.5% in interest back in November. And now it's over +1, okay? So it's gone up by 1.5%. And remember Mark's formula, you take that change in the interest rate, 1.5%, multiply by the duration. If that's a growth stock we're talking about, 1.5 times 50 is 75%. Now there are subtleties here and we could go deeper, but it just sort of says to you, boy, these growth stocks as a whole, as a group, you can make a case that forgetting about recessions, forgetting about Russia and Ukraine, forgetting about oil price, forget all that stuff, right? It's still the case that you might expect growth stocks to drop 50, 60, 70, 75%, okay? Value stocks, probably more like 20%, okay? Well, 20% for value stocks, that's probably about how much they have gone down. But growth stocks have not gone down anything like 60, 70, 75%. I mean, a few of them have. So arguably, there's more room to drop for growth stocks, given the power of this simple calculation based on interest rates. And just so in case it's not intuitive as to why, just understand, if we were to say, oh, most of the value in Tesla is because 100 years from now, they're going to make crazy, crazy money. Well, you have to discount that 100-year number back at a much higher rate now than you would have 6 months ago. And as a result, that crazy money from 100 years from now, it's still real, but it's not worth as much today.
Well said. James, go to the next slide. We're just going to give a little more detail about what duration means, but essentially what Randy just described. This will be available. I'm not going to have to go through it right now to explain duration and why it's so key, but I think Randy did a terrific job of that. So if you don't mind, James, go to the next slide. Okay, so this is what we want to talk about with Randy. So Randy, I'm going to ask you the questions because I know you're looking at this on your phone, so it's easier for me to just read it to you, okay?
Thanks.
So there's basically 4 topics. The first question, what's going on in the markets and what can we expect going forward? So this is just an assessment of where we're at and where we're going. So you've touched on this a little bit, but anything in addition you want to share?
Well, so obviously I focus sort of on equities and divided the equities into more growthy and more value like stocks. If we talk about bonds, then the same duration thing applies, but we're talking about nominal rates rather than real rates. So with bonds, the price always moves. With safe bonds, the price moves the amount that it should move based on the interest rate. That's sort of a given. So really the question is, what do you expect going forward in terms of interest rate movements for bonds? So that, if the long bond went from, say, a little under 2% to a little over 3%, do you expect that rate to keep going up, to come back, et cetera? And there are arguments both ways. I don't have super strong feelings on it. But what I would say is this, even the 3% is not that hugely much of an expected return. And the risk of it going higher is certainly very real, right? You can absolutely come up with scenarios that are pretty compelling in terms of inflation and other things where that rate could be a lot higher than it is today, right? Because you look at the size of overall federal debt and so forth, and the market could reach the conclusion, hey, this is riskier than it used to be. We demand a higher rate of return. And if something like that happens, then you're going to see bonds continue to drop in a very substantial way. So when I look at bonds, when I look at stocks today, I sort of say that they went down in return, as a result of this real interest rate growth, but it isn't entirely clear they went down enough. And even if they went down the right amount, we know historically that when stocks crash, they tend to overshoot fair value. In other words, I think there's a decent argument that says the market now is in the neighborhood of fair value, that it was expensive 6 months ago and now it's kind of fair. But usually what we've seen is the market go below fair down to cheap before it comes back. So I think there's very significant risk in equities now, and that the expected return is not super high because they're not cheap yet. And then with bonds, what I'd say is, well, the expected return is what it is, right? If you buy a 3% bond, you're going to get 3%. But there's a lot of risk in that 3% number. So it doesn't feel like you're being very heavily rewarded for that. And so that's why I'm, very, very interested these days in alternative investments, because it feels like neither stocks nor bonds are super appealing on a risk return trade-off. And one last thing, historically, what was great with the 60-40 portfolio that was such a big part of traditional asset allocation schemes is that, well, stocks have risk, bonds have risk, but they kind of protect you against one another. And in particular, when stocks crashed, your bonds would protect you because there'd be a flight to quality from the stock crash, and then the bonds would go up. But as I've been telling people for almost a year now, that doesn't really apply now. Because what's happened is people aren't really afraid of a traditional stock crash. They're afraid of a bond crash where interest rates rise and bonds go down, and then stocks are going to go down too in a bond crash because they're also long-term assets. So the upshot is, if your stocks crash, your bonds protect you. But if your bonds crash, your stocks will not protect you. And that's what's happened so far this year. And it's not too unlikely to continue to happen. And if it does happen, then you'll lose on both your stocks and your bonds. So both because stocks and bonds individually aren't super attractive right now, and also because you're not getting as much diversification from a stock bond mix as you traditionally have. I think adding a big slug of alternatives to the portfolio really makes sense. And I guess while we're doing asset classes, I should say a quick word on real estate. I would describe the situation in real estate markets as either you think that real estate prices have already dropped hugely, and we just aren't seeing it reflected in the data because nobody's selling at the new lower price. So in other words, someone has a $500,000 house and it's just flat out only worth $380 now, but no one wants to sell at $380. So the price is down in any meaningful sense, but just the transactions aren't occurring. Or you think they're about to drop, because there's no way with mortgage rates double where they were just a couple of months ago that people are going to be able to make the payments to buy houses at the same prices that we saw in the past. And of course, and especially if you take house prices on an inflation adjusted basis. And I'm not an expert in commercial real estate, but I'm going to guess that things are similar there. So in other words, I think that story about the duration, after all, real estate is a very long duration asset. And you take that 1.5% real rate move, it should have smoked real estate prices. And to the extent that real estate indexes don't reflect a big drop, it's just because the transactions haven't come in yet. But I think you have to figure that real estate values are down substantially.
Okay, Randy, that's a perfect segue into what people should do with these economic headwinds. But ironically, you're not bullish, or my words, not your words, but bonds have a lot of risk right now. Stocks have a lot of risk right now. And real estate has a lot of risk right now. So holy cow, what do we do? So we're going to lead into your recommendations, but I put some constraints about your recommendations. So let me just share with you what those constraints were. And this is based on a chat we had the other day as well. So basically, in this uncertain interest rate environment, having a low duration instrument or product is, to the extent you can do it soundly, is a smart move, because who knows how high rates are going to have to go. And it's my personal opinion that the Fed is going to push us into a recession. So how much interest rate rise needs to accomplish that goal? Unclear. I'm suggesting low duration as a constraint would be 6 to 24 months, as a suggestion, okay? And you want a low credit risk instrument because if it is a recession, you want to still be money good. You don't want to have the person that you provided credit to not pay you back. So it's very crucial that you have low credit risk, and obviously you want high yield. You want as much yield as you can get with those other constraints. So I put down here 4 menu options. You can discuss them in whatever order you prefer, but I started with liquid private equity, which I know is something you're very passionate about. Private credit, short-term promissory notes, and convertible preferred stock. So where would you like to start first?
Yeah, well, let me start by saying that, obviously, like you and I have been, discussing this stuff in depth for the last couple of years. And so it shouldn't be a shock to our audience that you and I reach, sort of similar conclusions on the right way to invest in this difficult scenario. And what's frustrating, of course, is you might think, oh, we'll just wait it out. but a financial expert friend of mine like say the one thing you absolutely don't want to be in an inflationary environment is cash, right? Because you're just giving up 9% a year, and that is truly painful. Now, obviously, if you have an inflationary environment with very high short rates, like we had when I was a kid in the 1980s, that's another matter. But that's not the world we're seeing, right? You still can't really earn much on straight cash, and meanwhile, you have this heavy inflation tax, so it's pretty painful. So I do like the set of options you're offering up. I think they solve a lot of problems. Let me speak about liquid private equity first, because as you say, this is really my passion. For 22 years now, I have been going anywhere in the world where they'll have me, whether it's in person or by Zoom, now that we have Zoom, and telling people about liquid private equity and why it's such an exciting idea. Look, private equity is the best performing asset class in the markets. It's delivered performance 2 or 3% a year ahead of public markets. But when the markets crashed, it hasn't gone down very much historically. So that is a powerful combination. And moreover, its correlation with stocks and bonds is low enough that it offers something of a diversifier. Now, there is controversy over the low volatility and low drawdowns in crises of private equity. What critics say is that they're accomplishing this with mark-to-model accounting. In other words, first quarter of 2020, stock market's way down. Private equity says they're only down a little. Now, stock market people's view is, well, private equity just kind of, they get to just decide how much they think that they should be down. Private equity's answer to that is, listen, we think the market panicked overly in COVID. And we as private equity are not obligated to panic just because the public markets panic. And of course, private equity came out looking really smart from that one because the market came back so strong later in the year. And private equity said, see, it wasn't as bad as you thought, and we chose not to panic. So there's some debate about that. I'm not here to resolve that debate. What I'm here to say is people want something that has high average returns and doesn't do too badly in a crisis. And so I have been arguing for, and in the last 5 years, actually developing products in the space that deliver liquid private equity, which is to say, we have the data on what private equity owns. And we can then buy companies in the public markets that perform, that look just like the companies private equities buy. In other words, take advantage of their wisdom. They are really smart about what industries to tilt towards. They are really smart about what kinds of companies to buy within each industry, basically high profit, low multiple companies. They're smart about leverage, and they're smart about downside protection. So let's create something that does the same. And so, I have a white paper where we show that it really is possible to deliver something that performs historically like private equity and gives you that downside protection. And of course, it has to use options to hedge. That's the only way in the public markets that you're going to get that same downside protection, but you can do it. And I think, developments in recent markets and crashes, sort of prove out the model. I think it's something that really works. So that's something that I think, especially if people can't invest in a diversified portfolio of traditional private equity. It's nothing, I'm not criticizing traditional private equity. It's just that it can be hard to access unless you're really crazy rich, right? If you've got $8 million, you're pretty rich. But if you want to put 20% in private equity, like an endowment would, that's $1.6 million. You can only make the minimum of one fund. You don't want your money to have 20% of your money in a single private equity fund. You want to be diversified across many funds, or if you can't, I recommend liquid private equity. So that's the first one. I'm really a big fan of that approach. I think that chunk of the portfolio, that 20 or 25% that institutions put in private equity, belongs in private equity for individual investors too. And if you can't get a great portfolio of traditional PE, then liquid PE can fill that void. Do you want me to move on to the other ones, or do you want to follow up with questions and leave you?
Well, there's one question that just hit the chat box, Randy. So let me ask the question John Stratton raised. So basically, his opinion is that the market convention is that there's a 50% chance of a recession next year. We can debate whether it's 50, 40, 30, 60. But
yeah, 50 sounds about right to me.
Well, that was going to be the next part of the question. What is your current assessment about recession risk next year?
Yeah, I think 50 is about right. And that makes me an optimist among people I know, because a lot of people think it's a sure thing, but it's just baked in the cake at this point. But I don't think that's true. I think that's really I understand people's concern. If I want to make the pro-recession case, I can make it, which is number one, we had an oil price spike, which historically has been the number one driver of recessions, right? So oil prices are way up. It's from a number of factors, but the main factor is that oil companies kind of shut down production during COVID when people weren't buying any gas. And they literally, you may recall the price of oil going negative in certain places because they literally had nowhere to put the oil. So they had to shut down production. But then it takes a long time to ramp back up when you shut down, and that just hasn't occurred yet. Obviously, the Russia-Ukraine situation has made things much worse. And there are other international relations factors involved there and so forth. So that's number one. And that, definitely puts a recession as a real possibility, even if nothing else was going on. And then second, you have, continued what people kind of euphemistically call supply chain imbalances. I would say it's really better just to say people had to make predictions as to what orders to place, what to purchase, and so forth. Famously, the auto industry said, hey, let's cut way back on our orders for microchips because we don't think we're going to be selling that many cars. When car orders ramped back up, the chips were spoken for, right? And there wasn't really any way for car companies to build those cars. They simply didn't have enough chips. Now, that's not, I don't know if you would have called that a supply chain imbalance. You can, but I think it would be better to say, look, they did their very best to figure out the best strategy in the circumstances, but there was a lot that wasn't known and they guessed wrong. And lots of other industries guessed wrong. I'm sure they did way better than I would have done, but they didn't get everything right. And that is economically costly, and that can help lead to recession. And then, of course, you have the Fed pushing up interest rates, which is certainly, they're deliberately trying to slow the economy. So is it likely that they'll slow it a little more than they want to and create a recession? Of course, that's a real possibility. So that's the bear case. And I think that there's truth in all that. At the same time, what's weird is the economy is super hot. And there's people who seem to be assuming, well, if it's hot, it's got to become recessionary. But that doesn't actually make any sense, right? In other words, right now, there's enormous demand for goods and services. A recession is when everybody says, I just want to sit on my cash and not spend it, right? And that we're not seeing anything like that right now, right? What we're seeing is there's more demand for goods and services than the amount of goods and services we can produce. So we're in a situation that's the opposite of a recession. And the Fed is trying to push us closer towards a balance. And yeah, they might overshoot, but they might not. I think it's kind of a little crazy to assume that it's just automatic that they're going to overshoot. Now, Milton Friedman famously said the Federal Reserve is like an idiot in the shower. The water's too hot, so they frantically switch it to cold. And then it stays too hot for a while, and they make it colder and colder. And then suddenly it blasts them with freezing cold water because, of course, they're not appreciating the lags in the system. Right. And that is the worry. The worry is that we were already on our way to inflation slowing down. If you look, the Fed themselves say that the inflationary measure they believe in is the core PCE deflator. Right. And that core PCE deflator has been at between 3.9 and 4.1% for the last 3 months. So it's at 4. 4 is not 2, which is the Fed's traditional target. But 4 doesn't seem like a crazy, terrifying, horrifying number either. Right. And so the point is, well, OK, but you also have high food and oil prices, which are not in the core. And you have a longer look back so that it's like, well, 6 months ago, prices were rising faster than that. So there's definitely an argument that says inflation's already easing substantially. And the Fed is now kind of trying to chill things, but they don't really need to do more chilling. It's getting to where it needs to go on its own. Or as a result of earlier Fed action, and so the Fed really should cool it and not keep trying to slow things down. So we'll see. The Fed might overshoot. I won't deny the possibility. I'm just saying that it's not guaranteed. And so that's why, even though it's sort of the lamest thing ever to say it's 50-50, you guys are probably familiar with Nate Silver, who runs the 538 website and is an election prognosticator and so forth. In his book, The Signal and the Noise, which I highly recommend, he says that weather forecasters will almost never tell you that there's a 50% chance of rain because people just hate it. They feel like they didn't get any information. So if it's 50% chance of rain, they'll tell you it's 70%. Or if it's 75%, they'll tell you it's 85% because people want to feel like they were given, they're more satisfied with the advice they're getting that way. And so I suppose I should learn from these weather people, but I actually think 50-50 is pretty reasonable.
Okay. Well, thank you for that, Randy. The next.
So I went on a little longer than I planned. Apologies.
No, it's great. I love it. Private credit as opposed to public credit. I'll call it Baskin Robbins. There's 31 flavors of private credit, but maybe give us a taste for the type of private credit? Again, you've studied these markets. What
Yeah.
type of private credit, particularly now,
Mhm.
are you seeing as a good risk reward opportunity for people, and what kind of
Yeah, well,
yields you can expect?
Yeah, and I really want to highlight your point, Mark, about short duration here, because in other words, if you buy those long dated assets, whether they're public, private, government, corporate, you are taking on a lot of interest rate risk. And again, your stocks are already susceptible to that interest rate risk. So if you go ahead and buy, whether it's a 30-year treasury bond, whether it's a 20-year corporate bond, whether it's a long-term private credit, if interest rates rise, you're going to get hammered on that asset, and your stocks are also going to get hammered. And so it's too much of the same kind of risk. So what people need to do, unless they've taken their equities all the way to zero, what they need to do is say, I don't want a lot more duration risk in my portfolio, because duration risk is substantial, and I already have a bunch of it from my equities. Maybe I have some bonds that are in there that I'm sticking with. And so you put that together, you're like, don't add more duration risk on top of that. If you buy credit risk where they owe you the money back in 6 months, a year, 2 years, now if interest rates rise, that doesn't matter. You'll get the money back fast, and you can reinvest at the new high rates. So it won't hurt you to do that. So that's the first point, is you really want to look for those shorter duration assets. And in private credit, where you're talking about stuff that is, significantly riskier than government bonds or whatever, all the more so that you want to make sure that you're not taking on a lot of duration risk on top of that credit risk. Now, the credit risk is real. Nobody's going to give you, a super high return that is absolutely positively guaranteed to pay. So, there are trade-offs. And as you mentioned, Mark, if we do end up in a recession, then obviously part of what a recession is all about is credits taking a hit. And so you'll probably experience some defaults on some of the credit risk you take on. And so you need to get if you avoid duration risk, B, you go with pretty safe credits, not perfectly safe, that's not going to be there, but pretty safe credits. And C, you diversify them widely. Then you can have a situation where even if a recession hits, you'll have a little loss here and a little loss there, but you'll be getting good returns. Oh, and I should say D, get high returns, right? And so, for example, I work with a group that's in private credit, and they do promissory notes of about 2 years duration. And they pay, in fact, the duration's less than that because they pay monthly interest. But they last 2 years, and those notes are and those notes pay 12%, right? So 12% is a really meaningful amount of interest when you look at your bank, which is paying you probably between 0 and 1. And so those opportunities are out there. And so I think that and the point is, that's a firm that is they're in the business of funding thousands of small merchants, right, of small businesses. And so the idea is, sure, some of the people they fund, they're going to do badly, but overall, they feel very confident they'll be able to pay their debts because they are, they're diversified across, dozens of states, hundreds or thousands of companies, et cetera, et cetera. So look for that diversification, look for that good credit quality, look for the short duration, and then look for somebody who's paying you at least high single digits for that. Because if they're only paying you 3 or 4%, it's not that exciting. Now, look, if it's really, really safe and you can get, say, 4 or 5%, that's still pretty interesting. I'd certainly rather have a tiny bit of credit risk and get 4% than hold government bonds, which have no credit risk, but 30-year duration to get 3%. So, there's, as you said, there's so many different kinds of private credit and credit generally that it's hard to make sweeping statements, but certainly reach out to me and Mark if you're interested in finding things in this space, because, we're seeing some attractive opportunities in the area.
All right, thank you, Randy. Last item that I suggested, we can expand the list. I'm sure if we want to, we could, but I put down convertible preferred stock as another item that can give income. It also gives you the potential of equity-like returns at a different point in time. But what's your feeling about that asset class?
Yeah, in fact, let me make a broader statement. I think that it's apt for the moment, but even going beyond this moment, here's a really good rule. The smartest investor I know has a thing he says, and this is literally if like his cousin, calls him and says, what do I do? I've got, 200,000 in my 401k. What do I do with my money? He says, look, when you buy bonds, you want to buy the risky bonds. And when you buy stocks, you want to buy the safe stocks, right? And I'll give you a massively oversimplified explanation of why that's the right way to invest. There are people who like risk who want high returns and they like risk, and they tend to buy stocks. And there are people who like safety and don't mind somewhat lower returns, and they tend to buy bonds. So the people who buy bonds tend to favor the safe bonds. And that means the risky bonds are tend to be too cheap, because there's just not enough buyers for them. There aren't that many people who are risk-loving enough to be, risk-hating enough to be bond people, but risk-loving enough to want the risky bonds. And the reverse is true in stocks. There's not that many people who are risk-loving enough to want stocks, but risk-hating enough to buy all the safe stuff. So if you create a portfolio of low beta stocks together with high risk bonds, that is a much better way to invest than the normal way with risky stocks and safe bonds, right? You're going to get higher payoff for less total risk. So let's think what that means. In the stock world, it means what people tend to call low vol or low risk or low beta strategies. And I can give you a very specific, easy to implement recommendation. And of course, if you want to go deeper and do better than this, talk to Mark, and he's got great ideas. But the Vanguard Minimum Volatility Index, and I can even tell you the ticker because it's easy to remember. It's sorry. now I'm gonna screw it up. V for Vanguard, and then MN, and then for minimum, and then VX, which is how Wall Street guys say volatility. VMNVX, right? That index, that index fund, very low cost, and it buys you the low risk stocks. And that's a nice way to play it. If the market gets hit hard, you won't do as badly. And on average, the low risk stocks have performed about as well as high risk stocks historically. Now, over on the other side of the ledger, what do we mean when we say high risk bond? Well, Mark says preferred equity, convertible preferred equity and convertible preferred bonds are, very similar securities. So we'll lump them together and say you've got a fixed income security. It's going to pay you a fixed rate of return, but it gives you the option to convert into stock, so that if things turn around and the company does really well, you can make a big multiple on your money. And so convertible preferred equity and convertible notes, convertible bonds, are two ways of getting that same best of both worlds structure. And I absolutely agree with Mark that it's a very attractive way to invest in general and especially right now.
Okay, well, Randy, thank you for that. I want to open it up for some questions. I'm sure there are people that probably have different thoughts on their minds, but I'm going to start, Randy, with one question. I get quite a bit from people that say things like, I own a lot of real estate and I thought it was safe and secure. The COVID crisis changed my point of view on that. And how do I get a more balanced portfolio that doesn't have all my eggs in one basket? So if I'm a 100% real estate person, what would be your recommendation for the incremental investments they have to basically try to rebalance their portfolio in a more prudent way?
So first, let me clean up something that I left out when I talked about real estate before. If you buy a new piece of real estate, then I think that at the prices that people are listing things at, then my belief is there's a very good chance you'll be overpaying because, as I say, the higher mortgage rates have not been fully reflected in prices, the higher real interest rates have not been fully reflected. But if you own a piece of real estate with a long-term locked-in mortgage at the low rates that prevailed until a few months ago, you actually have a bundle of securities, you might say. You have the real estate, which is probably a little bit overpriced, but you have the mortgage, which is the deal of the century right now, right? In other words, if you've got a 3% mortgage and mortgage rates are now, let's say it's a 3% 30-year mortgage or a 3.5, and mortgage rates are now at 6.5, that mortgage is unbelievably valuable. And so the fact that your real estate, you might say, oh, gee, it was worth $1 million 6 months ago, and now the most I could sell it for is, $700,000 or $800,000. Well, that's disappointing, but that's okay because you don't need to sell it. All you need to do is make the payments, and the payments are low because the interest rates are low. And meanwhile, if you're renting that piece of real estate, those rents are going to go up, up, up with inflation. Okay, so if you've got real estate and you've got a mortgage, and even if it's like a 7-year or 10-year arm with a lot of time to run, you're in great shape. on that. And you don't have to feel bad that you didn't sell it, because selling it would have meant, sure, you got out of the real estate at the top, but you'd also have given up the mortgage sort of at the bottom, if you will. In other words, that mortgage is more valuable now. So don't feel any need to kick yourself for real estate that you held on to. Now, if you bought real estate yesterday and had to take out a 6.5% mortgage on it, then, I would say, boy, if you paid listed price and then took out that big mortgage, you probably overpaid. But hey, we've all made investment mistakes bigger than that millions of times in our lives. So, just, forgive yourself. Okay. So now the question is, fine. Suppose you have a lot of real estate. Real estate's been your main thing. Again, if you've got those locked in mortgages, that could work out great for you, because I think we're going to see rents climbing and climbing over the next, even if inflation calms down, in the next year or so, which I think it probably will to a great extent. Still, just this year's inflation and next year's inflation, that's a lot of rent increase with your mortgage, your main cost being your mortgage being fixed. So I think that's going to look pretty good. But I absolutely agree with Mark that at any time and place, if you have a portfolio that's almost all real estate, it's the right time to diversify, because it's just not, the market is going to offer a risk return trade-off on assets that is the fair risk return trade-off if you're diversified. And if you're not diversified, you didn't get enough return for the risk. You see what I'm saying? Stocks will pay you such and such a return for the risk you take on. But that's because that's the market price of risk, because they know that investors are diversified in other asset classes too. And if all you hold is stocks, you're not getting enough reward for all that risk you're taking on. You're overpaying or getting underpaid, you might say. So what do you need to get into? Well, it's really the kind of stuff that we talked about. Private equity is interesting. There'll probably be a lot of opportunities for new private equity funds to scoop up bargains, but if you can't get into traditional private equity in a really high quality, diversified way, then liquid private equity can be a great solution. Private credit is a very juicy area right now. And just, with all the cautions that Mark and I talked about, I think there's a lot of other interesting things in alternatives. There was this old term hedge funds, and people aren't using that term as widely anymore because it had a kind of a cowboy image to it. And look, some of those cowboys delivered some fantastic returns. So I'm not saying there's necessarily anything wrong with being a cowboy, but it was an approach that, not as many people wanted for the long run. People liked it when it was doing well, and then it didn't do well, and they'd be like, you know what, this isn't for me after all. And I think we've got kind of alternatives 2.0. So instead of that old 90s and early 2000s style cowboy hedge fund, there's a lot of new kinds of alternative investments. And the private credit stuff we've been talking about is one arm of that new world of alts. But there's a lot of other interesting things in there. And as a very general rule, I would say, think about something like, think of a spectrum where at one end of the spectrum, you have things that have been around a long time and have consistently made money and everybody knows works. And at the other end, you have new, exciting things that could be amazing, but they haven't proven themselves. So the problem at this end of the spectrum is, well, let's face it, anytime somebody shows you two ends of a spectrum, they're probably selling you the middle. And I'm no exception. I believe in the middle. Okay. I'm the happy middle child in my family, and I believe in looking at the middles of things. Over here, you've got stuff that, like, look, it's still going to work, but it's not going to work nearly as well as it did because people know that it works and they bid up the prices of things. And so they're just not as juicy as they used to be. And that could be anything from just buying equities, which used to be an incredible bargain 50 or 100 years ago and isn't so much of a bargain anymore. Could be something like, strategies like merger arbitrage, which are still good strategies, but they just don't pay off nearly the magnitude they used to. Over at this end of the spectrum, you've got machine learning and artificial intelligence. You've got crypto stuff, right? Obviously, a lot of people have taken a lot of pain in crypto. I've been telling people for the last 5 years, I wrote a paper in 2017, and I said, look, there are two reasonable allocations to crypto. One is zero, and that is to say, you know what? I don't know what's going on here. It's too risky. I'm not going to swing at this pitch. And the other is 2%, to say, you know what? This could be the next big thing. And if it is, I want to make a lot of money, but I know there's going to be waves and crashes all along the way. And so I can't afford to put a huge amount of my money into it. Now, obviously, there are people who put 30% of their money in crypto and made a killing, and hats off to them. But we see that crypto is something where you want to be moderate in your risk, but it's also completely okay to say, you know what, this one's not ready yet. It's not a mature market. All right, so what's in the middle of the spectrum? What are the things that are exciting? Well, it includes the things we've been talking about. It's basically take anything that big institutions, and that could be banks, that could be insurance companies, that could be private equity firms, anything that they have consistently made money off of that is now available in a more accessible, wider form. So for example, private credit used to be only banks would lend money to small businesses. It was a great business for them. Now it's much more competitive because there's other people offering that kind of private credit. So that's an opportunity. We know it works. There's lots of evidence behind it being something that really works. And now you can get direct access to it in a way that's much better than just buying stock in Citibank or something, right? In insurance, there's all kinds of interesting things, whether it's with catastrophe risk or with other kinds of insurance risk, where you take on some of the risk-bearing capacity and get compensated for it. And that's something that used to be you could do it only if you were Warren Buffett and owned a giant insurance or reinsurance company. But now regular people can invest in those kinds of strategies. And then liquid private equity used to be only the PE people could do PE type investing. But now you can take what's best about PE investing and do it in a liquid format that's accessible to anyone. So think about when somebody shows you an alternative investment, does this fit the profile of something that has shown itself to work, but is not so long in the tooth in its current format that all the juice has been squeezed out of the lemon?
Okay, Randy, thank you for that. We have about 5 minutes left. And as per usual, I want to leave the audience with, I'll say, 3 key takeaways. And I have my 3. So Randy, this is a heads up that in a couple of minutes, I'm going to ask you what key takeaway or 2 or 3 that you have for the audience.
Mark's ex McKinsey, because it's always 3, right? That's how they teach them at the consulting firms.
Exactly. What can I tell you? Well trained. There is time to the audience. If you do have one final question, please speak up. If not, we'll move on to the key takeaways. But if you want to ask your question, feel free.
Well, I have a question: if one is interested in the liquid private equity, as you mentioned, for people with less than 8 million to invest, how would you go about investing in that?
Yeah, look, if you you can either reach out directly to me. My email address is randy@hbs.edu, or if you don't have a pen handy and couldn't catch that in your head, just email Mark, and Mark will be nice enough to put us in touch, and I'll fill you in on what's going on in the space, including the project I'm working on, but also including, I'll show you the other things that are out there in case you like those better.
Great, thank you.
Okay, so I'm going to give you my 3 key takeaways from today. And Randy, you're buying an extra minute to come up with your 3 or less.
Great.
So firstly, current yield is available. It's a diversifier, and it's something that I think makes a lot of sense in this rate rising environment, particularly when you apply the constraints of low duration and minimize credit risk. There are attractive yields you can earn today. So definitely put that on your short list of things to consider. As a reminder, you have basically I bonds, as they're called, but essentially savings bonds. You can lock in from the U.S. government today 8%. Now, that sounds great.
Everybody should go buy. It's only 10 grand per family member, but everybody should go out and buy that today. It's amazing. I just bought them for my family.
Exactly. And then I think the knowledge of what duration means for the market in a rising rate environment, what it does to not only your bond and fixed income portfolio, but also what it does to your equity portfolio. If you have a long duration asset and the Fed is in a rate tightening environment, which it is, you need to be aware of the risks you're taking on and do things to try to minimize that risk. So Randy, with 2 minutes,
I'll keep it to 1. I'll go academia style, Harvard Business School case method style, and just have 1. And it's just this: investing is always hard, but it is really hard in an environment like this. So, I'm sure everybody watching this is a really smart, thoughtful, successful person, and that's great. And my guess is that all of you have a lot to bring to the table in terms of choosing investments. But that said, get help too, get expertise. I mean, I'm supposed to be some kind of expert. I'm a professor at Harvard Business School. I don't just pick my own investments. I go and I talk to experts like Mark and to my other friends on Wall Street, my former students who are out seeing things, right? It's just too hard to do on your own. So, obviously I'm a big fan of Bridgepoint and all that. I'm involved, but the point is, if Mark's not the right guy, if Bridgepoint's not the right guy, find somebody who's really knowledgeable, or alternative, ideally more than one somebody, right? Find a group of somebody to kick around ideas with and really think about it, look at the trade-offs, because there's never going to be one magic bullet answer. It's going to be about diversifying across lots of things. You can't make money without taking on risk, but if you make each of the risks a tiny little bite and you diversify across them, then you can get a lot of reward and not have the risk bite be too painful. But doing that is something that's pretty tough to do on your own. Seek wisdom from lots of sources, and we'd love to be a part of it.
Well, Randy, that was a beautiful summarization. And just to remind the audience that Bridgepoint has its mastermind group, which is intended to be this community for people to share their investment ideas, share best practices. Bridgepoint pulling in, talented people like Randy and others to share their opinions of how to deal with this current and future market. So I'll just leave that as the final statement. But again, we're delighted that people attended. We'll see you next Thursday, and I wish you a great rest of your day. So thank you very much.
Thanks, everyone.